but U.S. consumers are still feeling the pinch. It still remains relatively high from their perspective. The U-Michigan Sentiment Index dropped to a 4-month low as nearly half of consumers surveyed said inflation was eating away at their living standards. Here with a more perspective is Kathy. I'm going to make sure I get this name right. I promise you. Bostjancic, chief economist over at Nationwide. Kathy, a pleasure to have you on our show. We thank you as always. I really want to talk about this inflation story because it kind of feels like the markets had priced in the fact that the inflation had indeed peaked. But I'm curious about some of the pricing of Federal Reserve cuts. Is it still fair to say that 2023 is going to be the year that we see that?
Thank you. Happy to be with both of you. Well, I think rightly so, the markets were very encouraged by the weaker than forecast inflation numbers yesterday. The markets had really been fearing another, really strong increase in prices and not getting that, both at the headline and core. Not surprising that the markets have rallied so much and reduced, as you said, the expectations for the Fed funds rate going forward. But I think it's premature to think about rate cuts at this point. And I think the first pivot, what we're about to see unfold, is the Fed dialing back from 75 to 50 basis point rate hikes. That should happen in December. Yesterday's data suggests, and if we had another good month of, or at least decent inflation readings, that should be, sanctioned. But, then the next pivot is, when do they go on hold? What's the terminal rate? And I think 5% is still a possibility. Markets are pricing it a little lower than that. What the Fed has told us is that, not 1 month is not going to make a big change for them, even maybe 2 months, looking at the entirety of the picture.
And I'm wondering, Kathy, how that comes across in the form of language. The Boston Fed President Susan Collins, in her interview with Bloomberg this week, talked about, at this point, the risk of over-tightening. Is that the kind of language you would anticipate hearing more from more Fed officials?
Yeah, I think you can hear both. I think on one hand, Chairman Powell and others have, Mary Daly, one of them, have made it clear that erring on the side of too much restraint was better than letting inflation perhaps continue at persist at a very high level into the medium to long term. But yes, there are others, Collins, probably Vice Chair Lyle Brenner, who are starting to say, well, we've done a lot. We need to look at the cumulative increase in the Fed funds rate and also the tightening of financial conditions. What impact? We know that's going to impact the economy with a lag. Let's make sure we don't overdo it. And the fact is, especially if you look at core goods prices, they're going in the right direction. They're finally really decelerating at a fast pace. We know that core services are going to be a bit stickier. So, they do need to calibrate and be more careful. And I think dialing back, going more slowly really, makes sense at this point.
Well, Kathy, in terms of being stickier, this has been a major question. As we look at perhaps rising oil prices, food prices, et cetera, what really catches my attention is that gas prices, for example, will ultimately come back down. You're already seeing them come back down as oil prices retreat as well. Food prices, on the other hand, say the price of cereal, for example, for the average American, you don't necessarily see markdowns on things like that, even though the materials that go into that cereal, for example, those contracts and those prices do come down. So talk to us a little bit about the stickiness of inflation and the timeline that we can expect for Americans to really get used to that.
You're absolutely right in that, when we talk about inflation slowing, it's the pace of increase moderates. It doesn't mean that we're going to revert back to lower levels. Now, gasoline, oil prices are a bit of a different story because they can be quite volatile, and you could see, reset in the price level. But other items, unfortunately, it just means that they'll rise at a slower pace. But we really need to look at things on a sector-by-sector basis. And as you pointed out, food prices really been painful for the average household. You're seeing year-on-year increase of 12%. That's basically 1% increase every month. That really eats into households' budgets. On the other hand, if there's excess inventories, like in apparel, we actually saw a decline in apparel prices. So it's kind of category by category. But I think the best we can hope for, in terms of an overall inflation, isn't necessarily a reset in the overall level of prices, but just a slowing in the rate of change.